Good morning, and welcome to session one of a two-session webinar on the topic of revenue recognition accounting standards as they apply to telecommunications. I am Jeff Irwin, and I'm a partner in the firm of Maynard Costerisan in Lansing, Michigan. With me today is Christy Summers, senior manager in our firm, and Zach Skriniars, also a senior manager with Maynard Costerisan. We all practice in the telecommunications area, and we want to take this opportunity to explain to you this important new accounting standard. Accounting Standards Codification 606, commonly referred to as revenue recognition, or even more simplistically referred to as RevRec, is a comprehensive rewrite of the accounting standards and processes for recognizing revenue for all entities. There are 5 steps to the revenue recognition standard. Today, we will discuss steps 1 and 2. We will complete steps 3, 4, and 5 next week when we continue this webinar. We will have some concluding comments at the end, and then we hope to have a few minutes for any questions that are submitted. Please use the chat box in the upper right corner if you wish to submit a question for us. Also, please feel free to contact us directly to discuss your situation or concerns you have. The new standard is effective for non-publicly traded entities as of January 1, 2019, assuming you are on a calendar year basis. I believe everyone on this webinar is a non-publicly traded entity, but for publicly traded entities, it went into effect January 1, 2018. This actually gives us some learning opportunities from their experiences. We'll be able to read their financial statements and glean information about their financial presentation and footnote disclosures. The core principle is to recognize revenue to depict the transfer of goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. The Financial Accounting Standards Board, also known as FASB, is the standard-setting board for United States Generally Accepted Accounting Principles, commonly known as GAAP. The FASB determined that there was inconsistencies and weaknesses in revenue recognition. They believe there has been a lack of comparability among different entities and industries. Over time, each industry has developed their own way of accounting for revenue. This is also part of an ongoing effort to coordinate U.S. GAAP with international accounting standards, often called IFRS. This standard is designed to identify basic concepts of revenue that all entities will apply consistently. It is intended to simplify the preparation of financial statements. All entities that record revenue are under the standard. That said, the telecommunication industry is expected to have an above-average need to change their processes. In fact, the American Institute of CPA has identified 16 industries to have a special task force on RevRec, and we folks at Telcom are one of the lucky winners in this area. The standard has been in development for many years. It was finally released in 2014, and then the effective date was postponed for 1 year. The FASB is still having discussions on how to implement certain aspects of the standard. But the new revenue recognition rules are here, and need to be applied in your accounting for 2019. Once you understand the new standard, you may decide to change the structure of how you charge your customers for services. There may be some pain in transition, but we believe once we work through the implementation, we'll have a process for revenue recognition that we can all understand and accept. Briefly, the newest standard identifies a 5-step process in determining revenue. Step 1 is identify the contract with a customer. Just because the term is a contract, do not think of a big 20-page signed and notarized document for each transaction. A contract can be written or oral. If you are billing your customers monthly for voice or internet or video, that is a contract. There is some good news. It is our opinion that universal service funds and high-cost loop support are not a contract with a customer. Therefore, USF, including CAF, BLS, CAF ICC, ACAM, high-cost loop support, are excluded from the provisions of the Revenue Recognition Standard. This is because the FCC and USAC do not meet the definition of a customer contract because USF is not paid on the behalf of a specific customer. Step 2 is identify the specific transaction obligations in the contract. Step 3 is determine the transaction price. Step 4, allocate the transaction price to specific performance obligations in the contract. Step 5 is recognize revenue when or as the entity satisfies the performance obligation. The fundamental issue is when do you have a contract with a customer? We will discuss contracts in more detail as part of our presentation, but we can tell you some specific exclusions in the RevRec standard. The standard specifically excludes leases, financial institutions, insurance contracts, guarantees, and non-monetary exchanges. Our presentation today and next week is going to be focused on explaining the 5 steps and how to implement them. With that, I will ask Christy Summers to discuss step 1 and identify when you have a contract with a customer.
Well, thank you, Jeff. Today, I am going to discuss step 1, identifying the contract with a customer. We will cover the definition and criteria of what a contract with a customer is, the portfolio approach or the practical expedient that is allowed to define groups of contracts, and what to do with contract modifications. First, we need to note this accounting standard applies only to revenue associated with a contract with a customer. This standard should be applied to a contract only if the counterparty of the contract is a customer. The FASB defines a customer as a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. A counterparty to the contract would not be a customer if the counterparty has contracted with the entity to participate in an activity or process in which the parties share in the risks and benefits that result from the activity or process, rather than to obtain the output of the entity's ordinary activities. An example would be developing an asset in a collaboration arrangement. In addition, a contract with a customer may be partially within the scope of the new revenue standard and partially within the scope of other generally accepted accounting principles or GAAP. In this instance, a company will need to determine what portion of the contract needs to be accounted for under the new revenue standard and what needs to be accounted for under other GAAP. The FASB defines a contract to be an agreement that creates an enforceable right and obligation between two parties, a customer and the entity, which must meet all of the following criteria. The parties to the contract have approved the contract, either in writing, orally, or in accordance with other customary business practices, and they are committed to perform their respective obligations. The entity can identify each party's rights regarding the goods or services to be transferred. Enforceability of rights and obligations in a contract is a matter of law. Enforceability may vary across legal jurisdictions, industries, and may vary within an entity. For example, the enforceable rights may depend on the class of customer or the nature of the promised good or service. All of these factors need to be considered when determining if there is an enforceable right associated with the contract. The enforceable rights will also be a factor when determining the individual performance obligations in the contract, which Zach will cover in a few minutes, and the term of the contract. The entity can identify the payment terms for the goods or services to be transferred. Month-to-month contracts are easily defined payment terms, but what if a company has a longer-term contract with a customer? There may be instances where the payment terms that are legally enforceable may not be the actual term of the contract. For example, assume a company has a 24-month contract with a customer to provide DSL services. The contract calls for a termination fee if the customer terminates the contract within the first 12 months, and no termination fee for terminating in the last 12 months of the contract. So what is the contract term? Well, here's where the standard gets a little tricky. What is the actual dollar amount of the termination fee? Is it large enough that it is unlikely a customer would pay the fee to terminate before the 12 months is up? Or is the termination fee nominal, and history shows customers would likely pay the amount to get out of the contract early? It is unlikely a customer would leave before the 12 months is up, then the term of the contract is 12 months, not 24, because the 12 months are considered to be enforceable. If the termination fee is nominal, a company would have to determine what they consider to be the enforceable term of the contract. One example of a way to determine this would be based on history of past customer contracts. A company will also need to determine if automatic renewal of the contract will be a factor in determining the term of the contract. Another criteria is that the contract has commercial substance. And is it probable that the entity will collect substantially all of the consideration to which it will be entitled in exchange for the goods or services that will be transferred to the customer? So basically, is the contract collectible? FASB has determined to evaluate whether collectability of an account is probable. An entity should consider only the customer's ability and intention to pay that amount of consideration when it is due. As Jeff had noted earlier, there are exclusions to this definition. FASB has determined that those revenue sources, whether in contract form or not, that are accounted for under other generally accepted accounting principles are not revenues as defined as a contract with the customer under the new accounting standard ASC 606. An example would be a lease contract. The revenue from the lease contract is accounted for under the leasing accounting standards and would not be a contract with a customer accounted for under the new revenue standard. In addition, as Jeff had noted, FASB has determined that contracts with governmental sources are not considered to be contracts for the exchange of goods or services and therefore not a contract with the customer. So funding received from NECA, USAC, etc. is not considered revenue from contracts with customers and should continue to be recorded as it has been in the past. So if we take a step back to what the definition of a contract with a customer is, you will notice the definition states it is a contract for goods or services that are an output of the entity's ordinary activities. So what is considered the entity's ordinary activities? Well, let's take a look at a simple example which will better explain what the FASB means by ordinary activities for a telecommunications entity. Assume XYZ company is in the business of providing internet services. They also own fiber in several areas that is used to provide the internet service. So during the year, XYZ company enters into a contract to sell a portion of their fiber network to another entity. Is the sale of the fiber network considered revenue from a contract with a customer? And the answer is no. XYZ company is not in the business of selling fiber networks. They are in the business of providing internet services. Therefore, the revenue from the sale of the fiber would not be accounted for under the new revenue standard because it is not considered an exchange of goods for ordinary activities. And another area that was of concern when the new revenue standard came out was whether or not regulated telephone operations or tariffed sales fall under the rules of ASC 606 as contracts with customers. Interpretation of the revenue standard indicates that individuals, businesses, and other entities receiving utility service meet the definition of a customer because an entity provides some or all of its regulated products and services to the customer, including a service to stand ready to deliver the commodity, the delivery of the commodity, and in many cases, the sale of the commodity itself. If we think back to the 5 criteria that must be met in order for there to be a contract with a customer and apply that to the entity's tariffed contract with a customer, you will see it meets all of the criteria to be a contract with a customer. Because 1, there is an agreement between the company and the customer, which generally occurs when the customer requests service orally and implicitly accepts the provisions of the tariff when it takes delivery of the service. 2, the company is obligated to provide service to all qualified customers under the terms of the tariff, and when it has done so, the customer is obligated to pay for that service as provided in the tariff. 3, the tariff provides the customer with the standard terms and conditions or rights, including pricing terms of the contract. 4, the contract between the company and the customer incorporates relevant terms and conditions of the tariff, thus the contract has commercial substance. And lastly, number 5, the company is entitled to consideration in exchange for delivering or standing ready to deliver the commodity to the customer. With all of that in mind, when do we need to reassess a contract? Well, if a contract does not meet the criteria at the inception of the contract and the company receives consideration from the customer, you will need to continually reassess the contract. Consideration received will need to be recorded as a deferred liability and only record revenue when one of the following is met. 1, there is no remaining obligations to transfer goods or services to the customer, or substantially all of the consideration has been received and is non-refundable. The contract has been terminated and the consideration received is non-refundable. Control of the goods and services has been transferred to the customer to which the consideration relates, and there are no other obligations under the contract and consideration is non-refundable. If a contract does meet the criteria at the inception of the contract, a company doesn't have to reassess the contract unless there is an indication that there was a significant change in the contract. One challenge the telecommunication industry faces with accounting for contracts under the new revenue standard is that our companies have numerous customers. This means each single individual landline, internet, cellular, data, etc. customers are potentially considered to be a contract with a customer that would potentially have to be kept track of individually. The good news is FASB has taken this into account and allows in the accounting standard an option for the entity to apply the portfolio approach or practical expedient to determine and account for contracts with customers. And in addition, if a customer has several contracts that have been entered into at the same time and meet certain criteria, they can be combined or accounted for as one contract. So first, combined contracts. In order to account for contracts as combined contracts, they need to meet the following criteria. The contracts were negotiated together with a single commercial objective. The amount of consideration to be paid in one contract depends on the price or performance of the other contract, and the goods or services in the contract represent a single performance obligation. Combined contracts are accounted for on a customer-by-customer basis, so you may end up accounting for less contracts individually, but there are still a lot of customers. So this is where the portfolio approach can be applied. With the portfolio approach, the new standard allows a company to adopt and apply the practical expedient to apply the revenue to a portfolio of contracts or performance obligations. The contracts or performance obligations must have similar characteristics and/or circumstances, and the financial statement effects would not be materially different from applying the standard to the individual contracts. Portfolio approach can be applied to some, but not all of a company's revenue streams. For example, a company could apply the portfolio approach to its residential customers, but the individual contract approach to business customers. Some examples of contract portfolios would be customer contracts comprise performance obligations within a similar pattern of recognition, such as bundled contracts, or customer contracts comprise similar goods or services within the contracts, such as only single line plans or only data plans. Or customer contract terms show similarities, such as duration or payment terms. And last example, customer contracts are within one reportable segment, such as business or residential. You will need to use judgment to determine whether or not to apply the portfolio approach, and if you do, how will it be applied. The goal of the method is to make reporting and recording easier, but only if using the portfolio approach will not cause the financial information to be materially different than if you reported and recorded each individual contract. The last item I'd like to discuss is what do you do when you have a contract modification. FASB defines contract modifications as a change in the scope or price, or both, of a contract that is mutually agreed upon by both parties. A contract modification can be defined as a change order, a variation, or an amendment. The contract modification exists when the parties create new or exchange existing enforceable rights and obligations of the parties in the contract. Contract modifications can also be written, oral, or implied by customary business practices. A contract modification should be accounted for as a separate contract if the scope of the contract increases because of the addition of the new distinct good or services, and the price of the contract increases by the standalone selling price of the new distinct services. If a contract modification is not accounted for as a separate contract, then it needs to be accounted for in one of the following ways: a termination of the existing contract and the creation of a new contract. This method would be used to account for new distinct services but no change to the standalone selling price, or a continuation of the existing contract. This method would be used to account for no changes in services but a change in standalone selling price. Minor changes to contracts may or may not cause a change in how the contract is accounted for, so professional judgment will need to be used to determine when and if to make the changes. So let's look at a quick example of a contract modification. So assume XYZ company enters into a contract with a customer to provide voice and data services for 24 months at a fixed charge of $50 per month. After 6 months, the customer decides to add TV services for an additional fee of $40 per month over the same term, for a total monthly payment of $90. So do we have a contract modification? And if so, what type do we have? Yes, we do have a contract modification. And the modification would be a new contractual arrangement because the TV services are a separate, distinct service, and there is a standalone selling price associated with the TV services of the $40 per month. The contract would be accounted for separately, and there would be no change to how the original contract for voice and data was being recorded. So at this time, I'll hand things off to Zach. He's going to talk about Step 2, identifying performance obligations.
Okay, well, thank you, Christy. I appreciate you going over Step 1. I'm going to cover the importance of identifying performance obligations in a contract, otherwise known as Step 2. Ultimately, this is very important to reach the end goal of recognizing revenue appropriately under the new standard, but it is also important to understand for Step 4 in this revenue recognition process. We will get to Step 4 during Part 2 of this webinar series next week. But as we made note earlier, Step 4 relates to the allocation of the transaction price to the performance obligations. As we discuss this step, try to keep in mind there is an additional end game to understanding the ins and outs of this step. So it's just very important to take in everything that we're saying in this step here, knowing that down the road on the next webinar part here, Part 2, we're going to get into more of the nuances of what really this step means and why it's so important. To start this step off, it's first very important to define what a performance obligation is per ASC 606. Performance obligation is a promise to transfer to the customer either of the following: a good or service or a bundle of goods or services that is distinct. We will go into the definition of what distinct means here in a moment as well. Or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. As mentioned, it's important to understand what the definition of distinct means as part of ASC 606 as well. So the following criteria to define how a good or service is distinct. Quick side note as well, both of these indicators need to be met to identify a distinct good or service. But as you can see on the slide, customers can benefit from goods or service either on its own or together with other resources that are readily available to the customer. That is, the good or service is capable of being distinct. And the entity's promise to transfer the good or service to the customer is separately identifiable from other promises in the contract, meaning promise to transfer the good or service is distinct within the context of the contract. When assessing your contracts with customers and trying to identify if you have goods or services that are separately identifiable, it is best to determine whether it's your overall promise within the contract to transfer each of those goods or services, or whether it's to transfer a combined item or items. In other words, it is identifying if multiple promised goods or services in a contract are outputs or inputs to a combined item. Inputs to a combined item may result in not having separately identifiable performance obligations, meaning the contract would have one performance obligation upon the completion of all the inputs to satisfy the overall output of the good or service. For example, if you purchased a license for software, and in addition to that purchase, related software updates were part of the contract, you are not affected by the transfer of the initial license by your promise to transfer the updates, but the need to have the updates to run the software appropriately creates the issue that the software and the updates are not separately identifiable. The one item needs the other, in other words. This is a broad, general example, but helps to understand when we have an item in the contract that relies upon another good or service within the same contract. We have included in the PowerPoint some examples of some potential performance obligations telecom companies may have with their customers. We felt it would be helpful to include some of these items so you can identify some of the areas in your own companies that you may need to review. As you can notice from the PowerPoint, some potential performance obligations telecom industries will need to identify are various things such as local landline services, internet services, cable services, equipment, incentives, cabs, IPTV, business systems, routers, modems, and really a few other items as well, as you can tell from the 3 slides there. A couple criteria that can help identify items that are not separately identifiable include, but are not limited to, integrating goods or services with other goods or services promised in the contract into a bundle of goods or services that rely upon multiple inputs to produce one output for the customer and per the contract. We kind of define that in the software license and upgrade example there. One needs the other, in other words. Another indicator is one or more of the goods or services significantly modifies another one or more of the goods or services promised within the contract. Again, meaning that the final output relies heavily on the one good or service that is unique to the contract. And finally, goods or services are highly interdependent or interrelated. Those are 2 key words there, and you'll see them bold on the PowerPoint. We mentioned these 3 criteria to help identify when goods or services are not separately identifiable. These may be the most common, but we are not limited to these 3. As a result, it is up to management to identify what goods or services in your company contracts are separately identifiable and what are not. As mentioned, as you will continue to hear, judgment is required throughout this revenue recognition process. Now that we have covered the basic definitions that are unique to Step 2, we will transition to specifics relating to telecommunications world and how identifying performance obligations will impact you. Consider this example. Your company offers voice, internet, and television for 24 months for $100 per month. Your customer can benefit from each service on its own, and none of the 3 services are highly interdependent or interrelated, as any of the 3 can be purchased separately. How many distinct services are there? In this example, we would have 3 distinct services: TV, internet, and voice, all separately identifiable. What if we use this example, but the internet must also have voice services, and you cannot purchase the internet separately from the voice services? In this case, we would have 2 distinct services. You would have the TV, and then you would have the internet and the voice, which would be considered one bundled service. This example helps prove how complex these situations in each company and bundle can be. Another area to pay attention to when it comes to performance obligations relates to equipment as a distinct promise. The question that comes into play is who controls the equipment, otherwise identified as CPE or customer premise equipment, the company or the customer. The first area to identify is if the CPE to the customer has a lease component. If it is identified that a lease component exists, then the company would follow the leasing standards in association with FASB ASC 842. If there are non-lease components, the company would account for the contract in accordance with the revenue recognition standard we have been discussing here today. For contracts that are identified as having non-lease components, the company will have to identify when the transfer of the CPE takes place and when the customer has control of that equipment. There are indicators to help identify who has control, the customer or the entity. Questions to ask yourself as indicators for customer control are: does the CPE provide an economic benefit to the customer? Does the customer pay for the CPE upon transfer? Or does the customer have risk and rewards of ownership of the CPE? A few questions you can ask yourself for entity control, meaning it's going to be leased equipment. Or does the entity retain legal ownership of the CPE? Does the customer enter the contract acknowledging the entity owns the CPE, and they acknowledge their return of that CPE to that entity? And is the CPE clearly marked as owned property of the entity? If you have determined that the customer has taken control, you must now identify if you have a separate identifiable performance obligation. To do so, you must analyze if separate performance obligations exist, This is done in 2 steps. Step 1 is, does the customer benefit economically from the CPE? This means if the equipment can be used, consumed, or sold for an amount that is greater than scrap value by the customer, then that is considered generating economic benefit to the customer. For example, if a set-top box has a secondary market in which the customer can sell the equipment for sufficiently higher than scrap value, and a cable satellite television provider will provision service to that new customer at the same rate as other customers, there is a benefit to that customer from the set-top box on its own. Contrary to that, if no other service provider will provision services to that customer using a set-top box that was resold or quote-unquote black market, then there is no economic benefit to that customer, and thus no separate performance obligation exists. Step 2 of this process is, does the CPE represent a promise to transfer the good to the customer separately from other promises? Overall, the majority believe the CPE provides a separate promise to the customer for a good, as it is typically explicit in the customer contract. Much like other areas, it might not be that simplistic though. The company should assess if that CPE is highly dependent on or highly interrelated, keywords there as we've kind of talked about from previous slides, highly interrelated with other goods or services promised in the contract. It gets back to does the company need to provide the service with the corresponding CPE? If the customer can obtain the CPE separately in a secondary market, are these services and CPE interdependent? If so, then the services and CPE may be identified as separate performance obligations as discussed in our example. As if this wasn't bad enough to observe already, there's one last area to go into in terms of identifying performance obligations specific to telecommunications. This area relates to promotions and giveaways. Here we are talking providing customers a free phone charger or other accessory with the purchase of a device. To begin, the standard does state that an entity is not required to identify promised goods or services that are immaterial in the context of the contract. You are required to evaluate whether optional goods or services provide a material right to that customer. The good news to that is there is a materiality assessment that can be done on these types of items. Understanding that materiality is both quantitative and qualitative. Also, if a contract contains several immaterial items individually, these should be reviewed in aggregate to determine if the total is material to the contract. Again, there's a lot of judgment involved here. Remaining consistent from year to year is also very important to this process. But I'll wrap this section up with an example of this premise. Say a wireless customer purchases a wireless handset, separately identifiable performance obligations, and a 24-month service contract, also separately identifiable. Included with the wireless handset, the customer receives a charger and a case that otherwise wouldn't be a part of the handset sale. The question then becomes, do we have performance obligations for the free promotional items? As the charger and case are not the primary goods sold, they do represent a promise made by the wireless provider, which the customer expects to receive. The customer could receive the benefit of these items as they are regularly available for sale separately, or could be purchased from another vendor, and these goods are distinct. Therefore, it could be determined by the wireless provider that the charger and case are separate performance obligations. This is true if it is determined that these items are material to the context of the contract. Again, getting back to the fact that you can review for materiality in these instances. But overall, that concludes this section of Step 2. I understand we kind of leave you on a cliffhanger here, as the remaining 3 steps are to be discussed in Part 2 of this webinar. It explains why this step is so necessary in assessing how to recognize revenue within your respective companies. I appreciate everyone's time today, and I will turn it over to Jeff to conclude on Part 1 of our webinar series.
All right. Thank you, Christy and Zach, for reviewing Steps 1 and 2. So we've just heard the first 2 steps of the 5-step process of revenue recognition. To recap, again, Step 1 is to identify the contract with the customer. We learned that a contract can be oral as well as written. It needs to have the approval and commitment of the parties involved. The contract needs to specify the parties' rights. It needs to establish the payment terms. There needs to be commercial substance. And finally, collectability needs to be probable at the onset of the contract. When you provide voice, internet, cable TV to customers, they come in and pay on a month-to-month, that's a contract. It's important to have a system of internal controls in place to monitor contracts and make the appropriate accounting changes as a contract changes. It's also important to study and understand how each contract works. What may appear to be a similar situation may have different aspects that result in different answers between the companies or contracts within the same entity. Step number 2 that Zach discussed is to identify the performance obligation. Performance obligation is a commitment to transfer a good or a service to a customer. In other words, we need to break down what we're doing for our customers, what it is we're selling or providing. What we might think of as one event or transaction will often have multiple obligations. For example, what if you give a customer a tablet to a new internet subscriber who signs up with a 2-year service contract? Is that a separate performance obligation? It is a distinctive performance obligation if it benefits the customer on its own or with other goods or services, and the company transfers of goods or services is separately identifiable. If it is material, it probably is a separate performance obligation. I'm going to conclude with 2 terms I think might help us. The first one is materiality. In our situation, it means if something is immaterial, we can ignore it. We may not need to record a performance obligation if it's immaterial. We as accountants and auditors try to compute materiality as a formula to get to a number. But really, the broad definition of materiality is would an informed user of a financial statement draw a different conclusion if something had been recorded differently? Does it have a material impact on the user's decision? In that regard, to revenue recognition, we need to determine if the item is immaterial in the context of the specific contract with a customer. We do not assess materiality at the level of the entire financial statements for this purpose. That would be a much higher level of materiality. Also, materiality can be quantitative or qualitative. I think some of the things you're going to work through, we may be able to conclude are immaterial. Not always, but sometimes. The second phrase I want to point out is practical expedient. I think you may have heard that already used. This term appears a lot in the literature on revenue recognition. A practical expedient is a way to do something more efficiently. Really, we are talking about a shortcut. Please try and look for practical expedience whenever possible. Please join us again on Tuesday, April the 24th at 9 a.m. Eastern Time for the next session of our presentation of revenue recognition accounting standards. We will now go into questions.